Hello and welcome to part 1 of the lecture for chapter 7. In chapter 6, when we talked about merchandising businesses, most of the entries when we were selling product would just tell us what the cost of those products were. Now we're going to figure out where that number came from. So in a simple business where we buy one product and resell it, and every time we purchase that product we pay the same price for it. Say we buy widgets for $6 and sell them for $10, and every time we want to buy widgets they're always $6. Well, that would be really easy to figure out what the cost of the sale is. The complexity comes in when we buy widgets at different costs and have to then figure out, well, which widgets were the ones we sold to the customer and how should we cost that if we bought those widgets at different costs along the way. So that's the tricky part. That's what we're going to talk about in this chapter. So in the first part of this lecture, I'll talk about just control of inventory in general. And I'll give you an overview of some inventory cost flow assumptions, and then I'll go into more detail for the FIFO assumption, or first in, first out. In the second part of the lecture, I'll cover LIFO and weighted average in more detail, and then we'll talk about a couple of other issues relating to inventory. So first, inventory control. This is going to be different for different kinds of businesses. Some businesses have things that are prone to being stolen. Obviously, you need to safeguard cell phones and iPads and things like that. You might not need to safeguard huge concrete conduits or something, that is unlikely to be stolen. So it's going to depend on the business. The important thing, and I relate this back to internal control, is what kind of documents are used. So companies should use purchase orders that are pre-numbered so you can control what purchase orders have been issued by the company, and if there are gaps, what's happened, all of that. They should be issued only by authorized personnel within the company. Receiving reports should also be pre-numbered. That's a document that records when something comes to the warehouse that should then be paired up with the purchase order. And then the vendor's invoice, that should indicate how much was charged for the product, how many were delivered, all of that. And that vendor's invoice should be in agreement with the purchase order and the receiving report. And then we should have an updated inventory subsidiary ledger. What that means is kind of like I described before, a binder where you have one page for every item that you have in stock or in inventory, and you update that to say what has come in and what has gone out. So at any given moment, a customer could call and say, how many of item XY100 do you have? And you should be able to look in that binder and say, we've got 13. And that should be accurate. So every business needs to count their inventory physically at least once a year. Good businesses that have perpetual inventory systems will usually do cycle counts as well. So every couple of days or every week they'll go out and count selected items and compare them to the subsidiary ledger and make adjustments. If there are significant differences, they may do some research about why those differences are occurring so they could make the system better. So I'm going to talk a bit now about different kinds of inventory flow assumptions. You can see here we've got a situation where we purchase a product and the first time we buy it it's $9, the next time we buy it on May 18th it's $13, the next time we buy it on the 24th it's $14. So that costs are changing. So depending upon which one, and I sell the product that I just purchased for $20. So the key thing there is, well, which one did I give to the customer? Did I give them the oldest one? That's the first column in the lower section there. That would give me cost of merchandise sold of $9 and ending inventory of $27. I'd have the $13 and the $14 units left. If I sold the middle one, the $13 one, I'd have cost of merchandise sold of $13, inventory of $23, the first one and the last one still in inventory. And then if I sold the most recent one I purchased, I'd have cost of merchandise sold of $14, and I'd add an inventory of the oldest two, the $9 and the $13 one. Notice in each of these cases, the cost of merchandise sold plus the ending inventory equals the $36 that is the total amount I spent. That's a good way to check your math on these problems. Look at what is the cost of the pile of goods that I have. So beginning inventory plus purchases, that's how much stuff I have. And I'm going to be allocating that dollar amount between what left with customers, that would be cost of merchandise sold, and what remains on the shelf. That would be ending inventory. So in each of those cases, those two numbers add up to 36, as they should. So there are 4 different cost flow assumptions that we can make. The first one is the best, but it's also the most difficult to do for most businesses. That's specific identification. So if I have a car lot, there are vehicle identification numbers on cars. I could record the cost of a particular car I bought, and then later when I sell that car, I could record that exact cost against that sale. So I'm matching the exact amount I paid for a product when I sell that product. So that works for high-end jewelry, it works for cars, things like that. Custom houses, those kinds of things, we could record cost and then deal with it that way. That's tough for small businesses though. For businesses that sell a lot of products. Those businesses have to adopt an assumption about how products flow through their business. And the assumption that they use for accounting purposes doesn't necessarily have to be the way products actually physically flow through the business, but that's going to capture the truest picture of what's happening in the business economically. So the first one is the most popular. Most people, most companies use this method. It's called first in, first out. FIFO for short. What that means is the oldest products are what are given to the customer first. So we're always cycling through our products and selling the oldest ones and keeping the newer ones and moving them through. A good example of that is milk in a grocery store. They load it from behind, so the newer milk is in the back, and that pushes the older milk to the front that customers take as they purchase their milk. The next example is LIFO, or the next method is LIFO, which is last in, first out. It's the exact opposite of FIFO. And a good example here is a big pile of bark for gardening. So they chew up trees and create new bark, which they add to the top of the pile. And when you come with your pickup truck to get a load of bark for your yard, they take that from the top of the pile. So the last stuff that was added is the first stuff that goes to a customer, and the oldest stuff might stay in inventory forever. The last method is weighted average, and that's just says we're going to add inventory, we're going to mix it all together in effect, and customers are going to take an average of that each time. The example here is a gas station. So you may have your tanks filled on Monday at $2 a gallon, again on Wednesday at $2.10 a gallon, again on Friday at $2.20 a gallon, and somebody comes and fills their truck up on the Saturday. What are they buying? They're buying a mixture of all the gas that's in there. So each time we make a purchase, we recalculate what our average cost is. This method is going to give us the cost of merchandise sold that will be in between FIFO and LIFO. If we have an inflationary situation where costs are increasing, FIFO will always give us the lowest cost of merchandise sold because we're giving customers the older, cheaper stuff. LIFO will give us the highest because we're giving customers the newest, more expensive stuff. Weighted average will be in between the two. So here's an example of those 3 parts that we talked about earlier, and I'll show you FIFO, LIFO, and weighted average for these 3 items that we purchased. Remember, we bought something for $9 on the 10th, $13 on the 18th, and $14 on the 24th. So if we went with FIFO, then we would assume that we gave the customer the oldest item, the $9 item, and kept the $13 and the $14 items in inventory. If we went with LIFO, we would assume we gave customers the May 24th purchase of $14, and we kept the 10th and the 13th item or 18th item in inventory. And weighted average, I would take the cost of all 3, add that together, divide by 3. I'd say the average cost is $12. So I would cost my merchandise sold at 12, and I would cost my inventory at 12 times 2. So you can see here when you look at the cost of merchandise sold for each figure, I have the lowest number for FIFO, $9, the highest number for LIFO, $14, and in between that at $12 for weighted average. So let's do a deeper review of the 3 methods. It's a little bit more complicated now. So in this example, and I'll use the same example for all 3 different methods that we're going to look at. FIFO first, and then in the next part of the lecture, LIFO and weighted average. So this company starts with 1,000 units of inventory that costs $20 each. They sell 700 units and they sell at $30. That's what they're charging the customer. That's not the cost. We have to figure out what the cost is. We purchase another 500 at $22.40. We sell 360 units, we sell 240 units, and then we purchase another 600 at $23.30. So the key thing that we want to do here is we need to figure out what are the costs associated with those three different sales and what is my ending inventory. That's our objective here. So here's the form that we'll use to do that. We've got a column for date, got a column for purchases where we look at the quantity, the cost, unit cost, and total cost. We have a column where we record sales of merchandise and then a running total of our inventory. So we start out here on January 1 with 1,000 units at $20, $20,000 in inventory. Next, on the 4th, we sell 700 units. Well, we just have one layer of inventory. We just have a $20 layer. So those 700 must have been those $20 units. So we cost that at $14,000. That now leaves us with 300 units in inventory costing $20 for 6,000 of inventory. Next, we purchased 500 units at $22.40, so now we have two layers of inventory, and it's important. Notice how I've repeated 300 at 20 for 6,000. I repeat that so that I can see after the transaction on the 10th, I have two, think of them as layers. I have two layers of inventory, the oldest layer at $20, the newer layer at $22.40. That allows me then when I make my next sale to see what my layers are so I can pull from them properly. So when I make the sale on January 22nd of 360 units, because this is FIFO, I'm going to give customers the oldest stuff first. So I give the customer 300 of the $20 units. That doesn't satisfy the full amount the customer purchased, so I have to dip into the $22.40 units and give them 60 of those. So the cost of that particular sale is $7,344. I would have to do this in order to come up with the entry that you see on the left side there. That wipes out my $20 layer, and I'm left with 440 units at $22.40, so I'm back to having one layer. When I sell 240 units on the 28th, they will all come from that $22.40 layer. So because there aren't multiple layers from which to choose. So I cost at sale at $22.40 each, and I have 200 left at $22.40. And then I go out and buy 600 at $23.30. So now I'm back to having two layers. I've got 200 at $22.40, and I've got 600 at $23.30. So my cost of merchandise sold for the entire period is $26,720, and my ending inventory is not a sum of that far right column. It's just the remaining what is left, those two layers of $22.40 units and $23.30 units for $18,460. So I will talk to you again when I lecture on part 2 of this chapter. Thank you.